If you retired in New Jersey, Minnesota, or California, and you've been thinking about moving to Florida to save $5,000 a year on state taxes, there's a number you need to see before you pack a single box: $40,000. That's roughly what it costs to sell your home and relocate. Realtor commissions, closing costs, movers, repairs on the new place. The math on a $600,000 house alone puts you at $36,000 just in agent fees. Add logistics, and you're already down $40,000 before you've even felt the Florida sun on your face. I've watched people run this calculation on a napkin. They see the $5,000 in annual tax savings and feel smart. What they don't see is that they just signed a net loss deal the moment they accepted the offer. And that's before 2026 changed everything, because the retirement tax map this year looks nothing like it did 18 months ago. The One Big Beautiful Bill rewrote how much of your local taxes you can deduct from your federal return. The SALT cap, state and local tax deduction, just jumped to $40,400. That one shift quietly closed most of the gap you thought existed between your high tax state and the no income tax states people keep moving to. There's also a new $6,000 senior bonus deduction sitting in that same law that most people haven't touched yet. Most people don't even know it's there. So today we're going to look at 3 states that are genuinely bleeding retirees dry in 2026. One state that almost no one talks about, but quietly offers better retirement math than Florida or Tennessee, and the actual cost of relocating once you factor in what the new law changed. By the end, you'll know whether staying put is actually the financially smarter move, or whether the numbers still work in favor of leaving. Let's start with the states you want to avoid. John and Linda are 68. They live in New Jersey, they've done everything right, and they're sitting on a pension, some Social Security, and a 401k they've been careful with for 30 years. And every year they look at their state tax bill and think, there has to be a better place to do this. They're not wrong to think that. But the 3 states I'm about to show you are not the answer. Vermont first. Most people don't think of Vermont as a tax problem. They think of it as a beautiful place to retire quietly. And it is. But Vermont has the lowest Social Security taxation threshold in the country. If you're a single filer making more than $50,000 a year, Vermont starts taxing your Social Security benefits. For a couple with a modest pension and some investment income, that threshold gets crossed fast. Add a top pension tax rate of 8.75%, and Vermont quietly becomes one of the most expensive states to grow old in. Minnesota is the one I'd call the real problem. The top income tax rate is 9.85%, and it applies to your 401k withdrawals, your IRA distributions, your pension, almost everything you spent decades building. There's no carve-out for retirement income the way other states offer. You worked for 35 years, you deferred that income, and Minnesota is right there on the other side of the finish line, waiting to collect nearly 10 cents on every dollar. California is the number everyone already knows, 13.3% at the top bracket. And yes, California doesn't tax Social Security, which is genuinely better than Vermont or Minnesota on that one item. But everything else, private pension, annuity income, IRA withdrawals, gets taxed at full California rates. If you're pulling $60,000 from a pension and $30,000 from an IRA, you're looking at roughly $5,400 in state tax per year. That's before you account for California's cost of living, which compounds the problem in ways that don't show up on a tax form. Here's what these 3 states have in common. They were all designed around an income tax structure built for working people. not retired people. The income keeps coming in: Social Security, pension, retirement accounts, and the state treats it largely the same way it treated your paycheck. The mechanism doesn't change just because you stopped working. I want to be clear about something. If you love the landscape in Vermont, or you moved to Minnesota to be close to Mayo Clinic, or your family has been in California for generations, none of that is wrong. Those are real reasons that matter. But you should know exactly what that state is charging you for the privilege of staying. Not roughly, exactly. Because the number is bigger than most people realize. And it compounds quietly, year after year, while you're busy living your life. Now, don't book a flight to Florida yet. Because that zero income tax promise comes with its own set of costs that most retirement calculators don't show you. I'll be honest with you. I've been close to making this mistake myself. A few years back, I was looking at a place near Sarasota. No state income tax, warm weather, the whole picture. Then I actually called an insurance agent down there and asked for a real quote, not an estimate from a website. A real quote for full homeowners coverage on a house in that zip code. The number I got back was not what the retirement blogs had prepared me for. Florida's average homeowner's insurance premium in 2026 has hit $7,136 a year, according to the Insurance Information Institute. That's not a projection. That's where the market is right now, after years of hurricane losses, reinsurance pullbacks, and carriers leaving the state entirely. In some coastal counties, you're looking at significantly more than that, and that figure doesn't include flood insurance, which is separate and, depending on your location, can add another $2,000 to $4,000 on top. So think about what just happened to your math. You moved to Florida to save $3,000 to $5,000 in state income tax. And your insurance bill went up $4,000 to $6,000 compared to what you were paying in a mid-Atlantic or Midwest state. The zero tax benefit didn't disappear, it just got rerouted. Instead of going to the state government, it went to the insurance company. The money left your account either way. This is what I mean by the communicating vessels problem. When a state decides not to collect income tax, that revenue has to come from somewhere. Florida collects it through property taxes, sales taxes, and an insurance market that the state has quietly allowed to price adjust for climate risk. The system is still taking its cut. The label on the line item just changed. Tennessee runs the same mechanism, just through a different pipe. There's no state income tax on wages or retirement income, which sounds like a clean win. But Tennessee's combined sales tax rate sits at 9.6%. And unlike most states, Tennessee taxes groceries. Not at the full rate. There's a reduced 4% rate on food, but you're still paying tax every time you buy groceries every week for the rest of your life. For a retired couple spending $800 a month on food, that's nearly $400 a year in sales tax on groceries alone. Add clothing, household goods, any home repairs, and the effective consumption tax burden adds up in a way that's invisible until you're living inside it. I've seen people do this without realizing it. They compare their old state income tax bill to Tennessee's zero, feel like they won, and spend the next 3 years quietly spending more than they expected without understanding why. The deeper issue is this: a state budget doesn't shrink just because you move there. The roads still need paving, the schools still need funding, the emergency services still run. The question is never whether you'll pay, it's which pocket they reach into. In Florida, it's your insurance premium and your property tax bill. In Tennessee, it's every transaction you make. That doesn't make these states bad places to live. It just means no income tax is not the same thing as low cost. Those are two different claims, and the retirement industry has spent decades conflating them. So is there a state that actually gives you clean retirement income exemptions without hitting you through the back door? There is, and most people scroll right past it. Pennsylvania is the state that almost never makes the retirement highlight reel. It doesn't have Florida's weather or Tennessee's brand recognition. But from a pure tax structure standpoint, it does something that almost no other state does. It exempts 100% of retirement income from state tax, regardless of how much you make. Not up to a certain income threshold, not with a phase out, all of it. Social Security, exempt. Pension income, exempt. 401k withdrawals, exempt. IRA distributions, exempt. It doesn't matter if you're pulling $60,000 a year or $160,000 a year. Pennsylvania's position is that income you earn during your working years and deferred into retirement should not be taxed again when you take it out. That's the mechanism, and it applies cleanly across the board. Let me show you what that looks like against a real number. Take someone with $111,000 in annual retirement income, a mix of Social Security, pension, and IRA withdrawals. In California, that person is paying roughly $7,200 in state income tax per year. In Pennsylvania, the tax on that same income is essentially zero on the retirement portion. If there's $15,000 in investment income or interest on top of that, Pennsylvania's flat 3.7% rate applies, so about $460. Total state tax bill, $460. The difference is $6,740 every single year. Over a decade, that's more than $67,000 staying in your account instead of going to Sacramento. Now, Pennsylvania is not a free lunch. The property taxes are real. Depending on the county, you're looking at $6,000 to $9,000 a year on a mid-range home. That's higher than Florida's average and something you need to factor in honestly. There's also an inheritance tax of 4.5% for assets passed to children, which matters if leaving something behind is part of your plan. But here's the thing, those costs are visible. You can see them on a bill, plan around them, and in some counties, offset them through Pennsylvania's property tax relief programs for seniors. What makes high income tax states dangerous isn't just the amount. It's that the tax on retirement distributions comes out quietly, automatically, year after year, on money you already paid into the system once. Pennsylvania's trade-off is transparent. California's is compounding. I've watched people overlook Pennsylvania specifically because it doesn't feel like an escape. It's not warm. It's not on the beach. It doesn't have the narrative that Florida has built around itself for 40 years. But for a retired couple sitting on a solid pension and a well-funded IRA, Pennsylvania's tax structure is genuinely one of the most favorable in the country right now. So at this point, you might be thinking, okay, the math works. I'll sell the house in New Jersey and move to Pennsylvania. And I understand that impulse completely. But before you do that, I need to show you a number that most people never account for. Because the move itself has a cost. And that cost changes the calculation in a way that might surprise you. Before I changed my mind on this, I used to tell people, if the tax savings are real, the move usually makes sense. Run the numbers, find a lower tax state, and go. That was reasonable advice for a while. But 2026 changed the math in a way I didn't see coming, and I have to be straight with you about that. Let's start with what the move actually costs. You sell a $600,000 home. Your real estate agent takes 6%. That's $36,000 gone before you've signed a single moving contract. Add the cost of getting your belongings across state lines, any repairs or updates needed on the new property, and you're realistically looking at $40,000 out of pocket on day one. Not spread over time, not deductible, gone. Now you're saving $5,000 a year in state taxes. That sounds good. But $40,000 divided by $5,000 is 8 years. You need 8 full years just to break even on the move itself, before you've made a single dollar of profit on the decision. If anything disrupts that timeline, a health event, a family situation, a housing market that doesn't cooperate when you want to sell, the break-even point pushes further out. That's the friction cost. And most people don't run this number before they start packing. Now here's where 2026 specifically changed things. The One Big Beautiful Bill raised the SALT deduction cap to $40,400. SALT, state and local tax, is what you deduct from your federal taxable income when you itemize. Under the old $10,000 cap, people in high-tax states like New Jersey or New York were losing tens of thousands of dollars in deductions they couldn't claim. That made moving feel urgent. That gap was real. Under the new $40,400 cap, a retired couple in New Jersey, paying $12,000 in property taxes and $8,000 in state income tax, can now deduct most of that against their federal return. The effective out-of-pocket difference between staying in New Jersey and moving to a no-income tax state just shrank significantly. That $5,000 annual gap I mentioned earlier? After factoring in what you can now deduct federally, the real difference is closer to $3,000. So let's rerun the relocation math with the corrected number. You spend $40,000 to move. You save $3,000 a year after the SALT adjustment. That's not an 8-year break-even anymore. It's a 13-year break-even. For someone who retires at 65, that means you don't come out ahead until you're 78. And that's assuming nothing changes in the meantime. There's also the Senior Bonus Deduction. $6,000 for single filers, $12,000 for couples, built into the same law. If you haven't applied that to your 2026 federal return yet, that's worth doing before you make any decision about moving. It reduces your federal taxable income directly, which changes your overall tax picture regardless of what state you're in. I'm not saying relocation is never the right answer. For some people, in some situations, it still makes sense. But the calculation that worked in 2024 does not automatically work in 2026. The law changed. The numbers changed. And a decision this size deserves the updated math. Let me show you what happens when you stress test this against the worst-case market scenario we've already seen this year. Earlier this year, a lot of retirement portfolios took a hit. The tariff volatility that ran through the first half of 2026 knocked many balanced accounts down 15% or more in a short window. For people still in accumulation mode, that's painful but recoverable. For people in the first few years of retirement, it's a different kind of problem. Let's run 2 scenarios side by side. Person A moved to Florida in early 2026. They sold their home, spent $40,000 on the move, and were feeling good about the tax savings. Then the market dropped 15%. Their portfolio shrank, and they were sitting on $40,000 less in liquid cash than they had 90 days earlier, because that money went into the move. They're not broke, but they're cash poor at exactly the wrong moment. If they need to cover an unexpected medical bill, a car replacement, or a home repair on the new property, they're pulling from a portfolio that just lost value. That's the sequence of returns problem hitting at its worst possible time, compounded by a relocation cost they can't recover quickly. Person B stayed put. They kept that $40,000 in their account. When the market dropped, they had options. They could sit still and wait. They could do a Roth conversion, moving money from a traditional IRA into a Roth while asset values are temporarily lower, which means converting more shares for the same tax cost. If they're in Pennsylvania, that conversion happens with zero state tax on the transaction, and they had the liquidity to handle any unexpected expenses without touching a depressed portfolio. The $40,000 isn't just a moving cost. In a volatile market, it's an emergency buffer, a Roth conversion opportunity, and a psychological cushion all at once. When you spend it on a truck and a real estate commission, those options disappear. There's one more number worth adding here. According to Fidelity's 2026 retirement healthcare cost estimates, average medical expenses in retirement have risen an additional 5% this year, partly driven by import cost inflation on pharmaceuticals and medical equipment. That number compounds. A retired couple that budgeted $300,000 for lifetime healthcare costs 2 years ago may need to revise that figure upward, and that revision needs to come from somewhere in the portfolio. Liquidity is not a luxury in retirement, it's a tool. And the decision to spend $40,000 on a relocation is also a decision to give up whatever that $40,000 could have done for you in the year you spent it. The stress test doesn't tell you never to move. It tells you to move with your eyes open and with a clear answer to the question of what you're giving up on day one. Don't let the belief that zero tax equals maximum savings be the thing that drives a $40,000 decision. That's the rehook, and it's worth saying plainly before we get into the steps, because that belief is exactly what the relocation industry has been selling for the past decade. And the 2026 law just made it significantly less true. Here's what you actually do before you make any move. Step 1. Calculate your real effective tax rate, not the headline rate. Pull out your 2025 state return and apply the new $40,400 SALT cap against your federal liability. Most people who do this exercise find that the actual gap between their current state and the low tax destination is smaller than they assumed, often by $1,500 to $2,000. That difference changes the break-even timeline in a meaningful way. If you're not comfortable doing this yourself, a CPA who works specifically with retirees can run this in under an hour. Step 2. Confirm you've activated the Senior Bonus Deduction. The One Big Beautiful Bill created a $6,000 deduction for single filers over 65 and $12,000 for married couples filing jointly. This is not automatic. It needs to be claimed on your return. If your tax preparer hasn't mentioned it, ask directly. For a couple in the 22% federal bracket, that $12,000 deduction is worth $2,640 in real tax savings. That's money that changes your calculation before you move a single piece of furniture. Step 3. Get an actual insurance quote from the state you're considering, not an estimate from a comparison website. Call an independent agent licensed in that state and ask for a full coverage quote on a home in the specific county you're looking at. Not a ballpark, a real number. In Florida especially, the difference between a county level quote and a statewide average can be several $1,000s per year. You cannot make a sound relocation decision without this number in hand. Do all 3 of these before you talk to a real estate agent, before you start looking at listings, and before you tell anyone you're thinking about moving. Because the conversation changes significantly once you have the real math in front of you. And once you have that math, there's still one more thing that can override all of it. Here's something I've noticed after years of watching people make retirement decisions. The ones who move for the wrong reasons almost never say, "I'm moving for the tax break." What they say is, "I've earned this. I've paid into this system my whole life. I'm done letting a state take money I worked 35 years for." That feeling is completely understandable, and I'm not going to tell you it's wrong. You did work for 35 years. You did pay into a system that often felt like it took more than it gave back. The desire to finally get out from under that, to move somewhere that feels like it's on your side, is a natural response to decades of feeling like the system was working against you. That's not a character flaw. That's a human reaction to a real frustration. But there's a difference between making a decision that validates that feeling and making a decision that actually improves your financial life. And the research on retirement behavior shows consistently that people in this phase of life are unusually vulnerable to what behavioral economists call the sunk cost fallacy. The tendency to make future decisions based on what you've already spent, rather than what the next dollar actually buys you. In practice, it sounds like this: "I've already paid so much in taxes, I can't stay here one more year." That sentence feels rational. It isn't. The taxes you paid last year are gone regardless of where you live next year. The only question that matters is what the next 10 years look like from a financial standpoint, and whether a $40,000 upfront cost makes the math work. There's also what I'd call the family prisoner problem. A lot of retirees know quietly that they won't actually stay in Florida or Tennessee for more than a few years. Grandchildren show up. A parent needs care. A health situation changes what climate you want to be in. The move that was supposed to be permanent turns into a 4-year detour, and now you've paid the $40,000 friction cost twice. I've sat with people who moved, came back, and never quite recovered the liquidity they gave up on both ends. They don't talk about the tax savings anymore. They talk about the 2 sets of closing costs. So here's the coaching point, and I mean this as directly as I can say it. Don't think of relocation as an escape from a state that's been unfair to you. Think of it as an investment. A $40,000 upfront investment with an 8 to 13 year break-even horizon and no guaranteed exit. If someone pitched you that deal in any other context, you'd ask hard questions before you signed. Ask the same questions here. Your retirement is not the place to prove a point to a state government that will never notice you left. Retirement in 2026 is not a race to find the state with the lowest tax rate on paper. It's a math problem with 4 variables: what you actually owe after SALT, what the move costs you up front, what you give up in liquidity when you spend that $40,000, and what your life realistically looks like in 5 years, not 15. The states that look worst on a headline tax chart are not always the worst place to retire, and the states that advertise zero income tax are not always the cheapest place to live. Pennsylvania, a state most people skip past entirely, quietly offers one of the cleanest retirement tax structures in the country right now. Florida and Tennessee offer real advantages, but they come with costs that don't show up in the comparison articles that get shared on Facebook. The One Big Beautiful Bill changed this calculation in ways that most people haven't fully worked through yet. The $40,400 SALT cap and the $6,000 Senior Bonus Deduction are sitting there, available for anyone who knows to claim them. Start there before you start packing. If you want to run your specific numbers, your state, your income mix, your home value, drop them in the comments. I'll work through the most interesting cases in a follow-up video. And if this kind of analysis is useful to you, subscribe to Wes Investor. The IRS and state tax rules are still moving in 2026, and when they change, you'll want to know before your neighbor does.